Hey traders, before we get into the video, we got to take care of the legal stuff here. Feel free to pause the video if you'd like to read the disclaimer. Basically what it says is I am not a financial advisor. Everything contained in this video is for educational purposes only. The information contained in this video is not an invitation or advice to buy, sell, or trade any specific security. You should be aware of all of the risks associated with securities trading and seek advice from an independent financial advisor prior to executing any trades. Now, if you do choose to trade based off of any information in this video, you do so at your own risk. Now, with that out of the way, let's jump into the content. Hey guys, what's up? It's Ace coming to you January 19th, 2022, 3:49 p.m. here in Cali. First and foremost, Happy New Year to all you guys. I know it's been a little while since I've created a video, since I think November of last year. I got tied up with the holidays and then of course trading and getting into the new year. And thanks a lot, by the way, for all you guys who have joined onto BlackBox stocks. It's been great having you in the community. I'm really happy to hear all the positive feedback you guys have sent me on becoming part of the community. I'm glad it's helping you in your trading journey, helping you to learn and helping you to get stronger as a trader. I did have somebody actually message me and was like, hey Ace, you don't really post a whole lot of like your outlooks on the market, and it seems like everything's going to hell in a handbasket because CNBC and all the talking heads on there are like, oh my gosh, there's this, huge down move and what do I do? I'm losing money. Do I get out of my positions? Blah, blah, blah. What's your opinion? Well, of course, you guys, I never give trading advice, nor should anybody give you trading advice. But what I can give you is my take on the markets and kind of what's going on. I think, CNBC and all these, stations, they sensationalize the news because it's what sells, it's what gets them ratings, but it doesn't help us as traders. What we need to do is focus on the facts and the technicals, which always will go ahead and lead us to making the right decisions. So with that being said, this is going to be a quick video on where I see the markets are at and the potential for where they could go, and kind of like, my take on it and how I'm viewing the markets for my own personal trading. So first and foremost, let's talk about the overall markets. We are looking at a chart here of the S&P 500 E-mini futures. I chart and track the S&P 500 pretty darn close. Actually, every single day I track it because that's the market. And it allows me to get an idea of really, the breadth of what's happening. Now, that's not the only thing I look at. We'll look at some of the other markets that I look at that correlate to the overall market, but the S&P E-mini futures I look at constantly. So what's happening, from here where we were at all-time highs to here where we're at right now? What happened to cause this down move here? Well, we have a couple of things that are currently weighing down the market, guys. These factors are first and foremost, we have stagflation happening. For those of you who don't know what stagflation is, this is basically when you get a rise in inflation with stagnant wage growth, okay? And that's not really good because the cost of everything goes through the roof, whether it's gas, whether it's food, transportation costs, everything is rising and yet wages are staying the same. We've also had a supply chain crunch, which has not helped out at all. You guys might have heard we have many ships sitting off the docks of LA. All the ports are backed up. And so, of course, that's making goods harder to get to the American consumer for them to purchase. Some of you in some parts of the country might have even seen some of your store shelves empty where the items that you're used to seeing are not there. All this is contributing to really a very tough economy, and it's weighed pretty heavily on the market, although the market has bounced back on this news quite a bit. We started seeing these supply chain crunches right in here, going into the close of the year, and yet we rallied back up to all-time highs again. So what's caused this most recent down move? Well, right here on January 5th, we had the U.S. Federal Reserve that finally showed its teeth. It hinted that the central bank is ready to move, or I should say is ready to get more aggressive about tightening its monetary policy, the tapering of its stimulus programs. And really, they set the expectations with the market that there's going to be multiple interest rate hike increases in 2022. The market did not like that information, guys, and on January 5th, we sold off to the tune of about 1.92% down on the SPY. I believe on Nasdaq, we were down about 3.12%, if I'm not mistaken. We can actually check that chart here just to double check. Here's the Nasdaq. Let's zoom in a little bit. And on that day, we were down 3.13%. So yes, I was just off by 0.001%. So anyways, going back to S&P. So Nasdaq really fell way harder on this news than the overall market. Nasdaq, obviously being tech, it pretty much led the downward trend hard in tech, which is why all the tech companies have been, not all, but most of the tech companies have been having quite a bit of sell-off, okay? So really, how is it that we can play this market? What's the idea here? Well, I will tell you one thing. I was looking at this zone right here. This is a demand zone, this green rectangle here. This is a demand zone that I have been looking at quite a bit since back here when it formed on December 7th, and it's held really well as support for the overall market. You'll see we moved up here and we came right down into this demand zone on December 20th. The demand zone was bought up by the institutional orders that were posted here in this demand zone area. Market rallied out of the demand zone back up to all-time highs, formed this very thin supply zone, and then came back down on the news of January 5th. And ever since January 5th, the market has just been reacting to this fact that, the party seems to be coming to an end, and, the monetary easing and all the free money and all the things that have kept the market going up. And so it's really this hard knee-jerk reaction. So we had a little bit of a pull up, and if you notice here on this hammer candle, where we have this long downward wick, there's a ton of buying pressure. It literally poked itself right here into this demand zone, immediately got bought up again and moved back up for this shallow pullback here in the overall downtrend. And then we reversed course and came right back into this demand zone. Now, yesterday, when we peeked our head into the demand zone, we actually went ahead and closed out yesterday's market right at the 100-day moving average, which correlated with the demand zone. Now, I got to be honest with you guys, when you have a third dip into demand, or third dip, because this would be considered the first one's here, the second one's here, and then this would be the third dip. A lot of the times when you get a third dip into demand zones or supply zones, either one, a lot of the institutional orders that were already here have been filled. And so there's really a good chance that this demand zone can easily have price slice right through it. But I thought we might get a little bit of a bounce up, a potential for a bounce up at least to the 20-day moving average, because 20-day exponential day moving average, because we were correlating with a 100-day moving average. And a lot of time that acts as dynamic support and resistance. But that did not happen, and today we actually sliced through the 100-day moving average, and we're all the way at the very bottom of this demand zone. And as you can see right now, and I'm going to zoom in on this, this is obviously the E-mini S&P futures market. It's open 24 hours a day, so you can already see tomorrow's candles printing, and it's already below the demand zone, which means that there's a really good chance this demand zone is no longer going to be valid and price is going to slice through it. So what does that mean? Does that mean that everything's coming to hell in a handbasket? Guys, I got to tell you something. We're at negative 5.62%. That's a 5.62% retracement from all-time highs, or pullback, if you will. We're not even in correction territory yet. You see where it says 10% off all-time highs down here? This is truly where you're entering a correction, is once you breach this 10% area, this dotted white line, which is 10% off all-time highs, all this down here is considered correction area. That's not even considered a bear market yet. It's considered a correction, okay? So a lot of people are kind of like really getting sketched out, and they're like, wow, the whole market's falling apart. All my positions are down. The sky's falling. This market actually really doesn't look that bad. I mean, it's not good, but retracements, corrections, they're healthy. Nothing can go up parabolically forever, okay? We have a couple of things happening here, guys. Even if we wind up slicing through this demand zone overnight and we open up with a gap down below to this demand zone here, we're coming down to 3 ATRs, okay? That's 3 average true ranges from the mean. That's quite extended, and I'm pretty confident that we should be seeing a bounce right around 4460.75 on the E-mini S&P 500. We should be seeing a bounce here because it is getting to that point where price is getting pretty overextended from the mean. Now, however, there's no guarantees, and the market could move down further. And if it does, we have 4 ATRs down here at 439.94, which is correlating with the 200-day moving average. Now, I don't see price breaking below the 200-day moving average or breaking down below 4 ATRs, but let's just say it did. Hell in a handbasket, whatever, elevator down. look at what we have below here. We have not only a daily demand zone, but we have a weekly demand zone. And I could tell you guys right now, within this whole green area that I'm moving my cursor in, there is a lot of institutional buy orders that would be put here, which would move this market up higher. Now, am I saying that we get down here and all of a sudden we're going to bounce and rise all the way back to all-time highs? Absolutely not. What I'm trying to give you an idea of is where there might be a little bit of stopping in the bleeding. This is bleeding. We're bleeding here. The market's selling off. Where do we stop bleeding out at? Well, here I've just given you some levels. 3 ATRs, 44.52, 4 ATRs, 43.92, and then of course right here, this entire area, which is pretty much from 43.76 all the way down to 42.48. I don't even think we're going to get into this demand zone. Not now. I think we would get to 3 ATRs, 4 ATRs, see a bounce up. Maybe we smack our heads against the 21 EMA, and then if we are going to get some further down movement, we're going to go down from there. Okay? So what does this mean? This means the sky's not falling, guys. This means that the market is basically correcting itself, and it is really unhappy that the Fed is saying that the money party might be coming to an end. Rate hikes are going to come in 2022. Monetary easing is going to go ahead and start tapering. And, you know, the people who enjoy the free money are not happy. That's the way I look at the markets. You'll see here, obviously, the VIX has been rising up. So we're above that 20 line on the VIX. And anytime you get above the 20 line, that means obviously you got a lot more fear in the market. It's a risk-on environment. So, you know, for me personally, I'm looking at this as an opportunity to breathe. I actually went ahead and put my 401k into bonds before this happened. So a lot of people might go 60-40 stocks to bonds split. I decided to go all into bonds and just basically just hang out in bonds for a little while to protect my assets, because I had a 10.8% return on my 401k in 2021. Not bad for managing your own money. And I just want to make sure I don't start 2022 losing any of the 2021 returns. So until I see this market get a little bit more righted from what's going on, I'm hanging out in bonds in my 401k. I have an IRA right now that I actually have invested 100% into stocks in an aggressive IRA. And so that I've taken a hit on. I think I'm down 5 or 6% so far on that, but I don't care. I'm not selling what's in that IRA. I'm hanging on to it because I know that this market's going to turn around. It's just we have to go through a little bit of a ride, and then we are going to see an uptick. And you know what? If it does come down in the future where we really are going to get into bear market hardcore, then I'll at that time I'll make those adjustments. But we're nowhere near there, guys. We're not even in correction territory yet, which would be sub 10%. So I just kind of, want to bring a little bit of a dose of reality to all the sensationalism that I'm hearing on CNBC and from all these people on TV. And I mean, it's really scaring the hell out of a lot of people. And honestly, I don't think it's that bad yet. I'm not saying it can't get bad. I just don't think we're there yet. Okay. If we look at Nasdaq, I love tech, but right now I would be short tech because obviously tech has crashed quite a lot harder than the S&P. So this is the Nasdaq E-mini futures. Once again, love following the futures because it tells me what's going on in real time, 24 hours a day, to the Qs and to the Nasdaq. So if we look back here on the S&P, we today just breached that 100-day moving average. We're still far above the 200-day. The 200 days down here, right around 4 ATR. If we go back over here to NASDAQ, the NASDAQ is literally right above its 200-day. So this is the 200-day. You'll see it says 200 right here, 200 EMA. This is a 200-day, and as you'll see, price is literally hanging out right above 200 days. So now, as far as NASDAQ goes, we do have, once again, massive demand zone down here. We have a daily demand zone within a weekly demand zone. I believe, once again, there's a lot of institutional orders sitting in here waiting to buy the market if it dips into this area. It's also correlating with the 3 ATR and 4 ATR level, which means once price gets to this point on the bell curve, we're way far away from the mean. So we are, prices have to, like a rubber band, they have to snap back. It's just how it works. So I do believe we will go ahead if we see some more down movement and we do happen to snap the 200-day. I think we will see a bounce right around 14,810 or possibly around 14,440. And that correlates, like I said, right with that demand zone. I think we'll see some institutional buying in here and the market go back up. Does that mean we're going to fly all the way back up to all-time highs? No, but we could easily fly it right back up into the 20 EMA. And you'll see right here, this demand zone has been breached. We had a bounce here, came up, formed into this demand zone. And you'll see it's interesting. This demand zone has actually had, even though this didn't breach it, I consider this a step 2 demand. So we had one sell here where institutional sell orders came in. And then, of course, we hit this demand zone, went right back into the supply zone, had more institutional sell orders that triggered and moved us right back down. Now this demand zone is dead. It's been breached. So actually in the video, I'm just going to remove this in real time because it's no longer valid. So bye-bye old demand zone. And here's where we're at overall with the Nasdaq. So for me, tech is short side play. And I have been doing some day trading on tech and doing pretty well in that, especially credit spread writing while the volatility is a little bit higher. It's been pretty good. What else is going on, guys? Let's just take a quick look here. I know the video is getting a little long. I wanted to go ahead and show you guys kind of some of the overall markets that I look at. Here's gold. Gold is very interesting. You can see people, a little bit of fear in the marketplace because, you know, people are flocking to the safe havens. So we had the symmetrical triangle that price is kind of coiling into. And then today, January 19th, we had a massive breakout of that symmetrical triangle. We had really good volume coming in. To me, that was kind of like the dam breaking a little bit, and a lot of people going, screw this. I'm hopping in, you know, I'm shifting my money out of, stocks and, you know, stock assets and more into safe haven gold. So it doesn't surprise me that we saw this breakout here today. And then, I don't know how gold's going to fare because it's got some serious supply zones above price. We have a daily supply right here, and we have a much larger weekly supply zone. Lots of supply to get to, lots of institutional sell orders, I believe, hanging out up in here. But we'll see what happens. I mean, if the market continues to tank, price on gold and the flock to the safe haven could very well cause this to continue to go up. One thing that's been absolutely killing me, and I'm sure it's killing you, is watching oil. Oil has been freaking ridiculous, man. I mean, seriously, we're up to, today we dojied at almost $86 a barrel. That's crazy. Obviously, all this is causing the price of gas at pumps to go up and go crazy. If you happen to get into USO, congratulations. I mean, holy crap. Look at the USO play. If we just come over here real quick, and I just want to show you guys USO because I actually thought of trading this and I never got on board. But look at this write up. This is crazy. USO just ripped right along with oil. Obviously, this is the oil fund. Down here, could have gotten in. What a great ride up. But still, I mean, help. If you could have gotten into that might have offset your gas bill, because we're all suffering quite a bit right now with the way things are looking as far as oil goes. Now, we did breach this supply zone here, and I was really hoping the supply zone would have held on oil, because that would have went ahead and hopefully have bought oil down to a more reasonable level. Maybe back down to some of these moving averages on a pullback, brought the cost of gas down a little bit, but nope, it's like hanging out up here. I don't know. It looks like there's a little bit of a roll on momentum, and we did have a little bit of selling pressure on this candle come in terms of selling volume. Maybe it will roll over a little bit, but seeing oil up at $86 a barrel really was just like absolutely freaking crazy. And for my own personal take on the price of gas, not too crazy about that. Bonds have been selling off, interestingly, right along with the overall market. You'd think you'd see bonds start to go up a little bit, but they seem to be pretty bearish. And then looking at the VIX, and I always look at the VIX in terms of the overall market, engaging when is a good time to buy and when is a good time to sell. Well, right now the VIX is telling me this is a sell side market for the most part. You got VIX right now that's been spiking up here over the last, several days, like the last week of trading, which makes sense because the market's been tanking. VIX has been spiking. We're over that 20 mark, so definitely risk on, fear on. However, though, we're rising up into this level where I think it's kind of like a blowout. As you see here, the VIX is blown out at this, what level is this we're clocking? Like 25 level. It's blown out here many times. It blew out once, blew out twice, 3 times. And then it blew out here 4 times, 4, 5, 6, 7, 8 times over here. And then, of course, here it exceeded it and here it exceeded it. But I do believe that, if we go ahead and we get to this 25 level, we should see, hopefully at that point in time, kind of an exhaustion low in the market. And when this begins to roll, kind of like it did here, and we see the TMO cross and we see momentum go negative on VIX and the VIX start to come down, that's to me going to signal that we have buyers now coming into the market. The risk is kind of, the risk and fear is, well, there's always risk on, but the fear is kind of coming off. It's subsiding a little bit. At that time, I'd expect to see the market rise. I would start looking at sectors, and I'm not going to do a sector analysis in this video. I might do it in another one, but I'd start looking and seeing which sectors are really are poised to start outperforming the overall market when the market turns around, and start looking to get long the strongest names in those sectors. Once again, video for another time. But anyways, wrapping this up, guys, the last thing I'm going to look at is Bitcoin. I look at Bitcoin just to see what the overall crypto market's doing. And to me, it's a freaking nightmare, dude. I mean, since we hit these highs up here at 70, it's just been downshipped the whole way through. It's very interesting because, this is why I love supply and demand zones, because if you look at this, guys, literally price went ahead and it fell until it found this, daily and weekly demand zone. We have daily inside of weekly demand. And once again, when you have daily inside of weekly demand, you have a ton of buying orders that generally are sitting here. This has never been touched, although right here it was definitely touched for a moment. Look what happened. Created this long wick and moved price right back up, although the overall downward trend was still intact. So what do I think is going to happen right now with Bitcoin? Honestly, I'm not really ultra bullish on Bitcoin at the moment. I think it will wind up going up again, but I can easily see if we don't have enough institutional buy orders willing to buy Bitcoin and crypto at this level, then I see it falling, and probably falling pretty hard. I could see it coming all the way down here. And let me just move this up here. I could see it coming all the way down here into this next weekly demand zone, which would start at 33,860 on Bitcoin. Do I think that's going to happen? I don't know. As long as it sits right now with inside of this daily demand, which is inside weekly demand, there's a chance that, if these buy orders if there is any buy orders there and they do get triggered, we can see an up move. But keep in mind, we're looking at 3 layers of supply zones above it. So there's a lot of work for Bitcoin to have to do in order to get back up to even close to where it was in terms of all-time highs. So guys, with that being said, that's a little bit of my market analysis, kind of just on the overall broad markets. Right now, guys, my humble opinion is, I'm not really swing trading anything on the bull side right now. I'm day trading to the downside, and I'm writing a lot of premium while the volatility is high. And I'll just show you what I mean. So, like, for example, if we go here, I'm on the E-mini S&P again. 500. And for example, if you just look at the 2-hour on the E-mini S&P 500 is such a great chart to look at to write credit spreads, because we're in an overall downtrend. So anytime you get these really shallow pullbacks, they're great areas to go ahead and write premium. You could have written premium here, written premium here. You could have written premium here. And even today, you could have written premium here early in the morning. And when I say write premium, I'm talking about writing them on anywhere from on SPX, you have every 2 days, you have contracts that expire. So, I mean, literally, if you're looking at a 2-hour chart or even a 1-hour chart per se, you could be writing these credit spreads literally just to be in them for a day or two and collecting some premium and making money that way, especially as we see these really shallow pullbacks on a 1-hour or 2-hour chart, and then a reconfirmation and price going with the overall longer term trend, which is down, just writing those bear call credit spreads over and over again. So just some ideas on how you can look at the market, maybe play the market while we're kind of waiting for things to shake out. I'm definitely not doing a lot of swing. Actually, I'm not doing any swing trading, and I'm really not doing anything as far as looking to buy yet. Once I see the VIX calm down and I see the market start to bounce, then I am putting together a list of bullish stocks that I would be looking to get into, or leap option contracts potentially on them. for a little bit of an upside play. Okay, guys, thank you so much for watching the video. I hope you enjoyed it. If you guys want me to do more market analysis videos, please post some comments down below. Let me know if this is content you guys like, or if I'm just like rambling on and you're like, dude, Ace, shut up, I don't want to hear what you have to say. Either way, let me know if you guys do like this kind of content and I get enough, thumbs up on the videos and enough people who are liking it in the comments. I will continue to do market commentary as I see it and bring that to you. And if not, then I'll, look to bring you guys some other content. My whole goal with my channel is just to provide to you guys something that you find to be interesting, entertaining, and hopefully helps you in your trading journey. Okay, so please guys, if you like the video, I'd appreciate it. It'll get it out to more people. Be sure to subscribe to my channel if you're not already subscribed. I have a lot of new content I'm going to be putting out, including some more educational videos to help you in your trading journey. Click that bell. Make sure that bell's clicked so when I do post, you guys get the alerts. And once again, guys, any questions, comments, post them down below. Thank you so much for watching, guys. God bless and trade well. Talk to you soon.